You're listening to the Option Alpha podcast from OptionAlpha.com, where we show you how to make smarter trades, learn how the stock market really works, and generate consistent monthly income. Now, your host and head trader at OptionAlpha.com, Kirk Duplessis.
Hey everyone, it's Kirk here again at OptionAlpha.com, working every single week to make this the most popular investing podcast offered online and in iTunes because it's based on one thing and one thing only, and that's helping you guys make smarter trades. So again, thanks so much for tuning in today. On today's show, we are going to be talking about pairs trading, and I don't think it's not the traditional pairs trading that you maybe have heard of or come to experience if you trade currency or stocks. But what I'm talking about is pairs trading with options, more importantly, to create just smooth portfolio growth, smoother returns, reduce the volatility in your account, because ultimately that's what I'm after. And I think that's what most people are after is we want decent returns. We're okay getting decent returns, but we also want really smooth returns. We don't want all these major ups and downs in our accounts and all this volatility, right? So again, we're not talking about like a traditional pairs trading today. Traditional pairs trading is more like you're shorting the, say the IWM and you're buying the Qs and you're trying to take advantage of maybe this differential and how they track together. That's not really what we're talking about today because that's really not what we do. We don't do that type of pairs trading. But I think I want to start the conversation today by just saying that everything starts with portfolio beta weighting. And I think it has to be the foundation. We've talked about so many times before, not only on videos and podcasts, but it has to be the foundation of what you do with your trading because you have to just know where you stand. Like, you have to not be blindfolded in understanding how your portfolio is going to react to the overall market. And I use the overall market as SPY in my case, because that's just what I've used for a long time, but use whatever index you want. The key is that it's better to be looking at one thing instead of tracking 17 different things, right? I feel like people who don't use portfolio beta weighting ultimately get pushed into it, right? Like not by choice, but they get pushed into it because the market, it's very difficult for them to manage 17 different positions and they're trying to look at everything at once. And I'm not saying that you like turn a blind eye to everything they're doing, but if you have one constant like goal that you're looking at, one indicator, one market that you're constantly following, and if you know how your overall portfolio reacts to that general market, then ultimately that's a lot easier for you. It saves you time. It's more efficient, right? And so with me, portfolio beta weighting is the basis of what I do for any new trades that I add to the portfolio. So that's why everything starts with portfolio beta weighting. If you understand where your portfolio sits at any given point in time, then it's very easy for you to go out and find new positions because you're finding complementary positions to the existing ones that you have. So the classic example of this is that if your portfolio is needing bullish positions, meaning that you're getting a little bit too bearish, right? And you actually make the most amount of money if the market heads higher and ends a little bit higher, right? That's where you make the most amount of money. Then you need to go out and you need to focus on finding more bullish positions, right? You don't necessarily need any bearish positions. You're covered on that end, right? You could have some, call credit spreads, or you could have some short calls, or whatever the case is. You're good on that direction. And so what your portfolio needs is bullish positions. And this makes it 100% easier because now you know what you're looking for, right? And we often use, like, my wife jokes with me when I go like shopping at the grocery store that like I'm like a seek and destroy type shopper, right? I think most men are, right? Like we have a list, we go in, we find what we need, and we get out. Like we don't like mess around, right? And women are generally, kind of like grazers, and they go in and they kind of shop and they look around, they have to touch everything, they have to feel everything, right? And they still might walk out with the same stuff we do. They just, go about it a different way. So when it comes to trading in your portfolio, you should kind of be the same way as like a guy going into the grocery store. Like you should know what you're looking for that day or that week so that you are more targeted, more focused. You can wake up, you check the markets, you find what you're looking for, make a trade or not, and then get out, right? And it's literally that. It's not this like analysis paralysis, grazing, walking around the store type analogy, right? You have to find what you're looking for and then get out. So with portfolio beta weighting, then, if you need a bullish position, just so we can talk about like what we'd be looking for, and then we'll go through some other kind of examples here so you can understand them. But let's say that, going back to our example, if we needed bullish positions in our portfolio, well, one thing that we can do is we can search for trades or ETFs or stocks that are then highly correlated with the market. Because again, if we're looking at one individual market index like the S&P, then we can use a ETF's beta or a stock's beta weighting to determine how correlated that security is with the market. And what we'd focus on then, if we need bullish positions, we'd focus on ETFs or stocks with a beta of 1 or more. And so remember, just to go back to beta and beta weighting, if you haven't listened to that podcast, you can search it and listen to it. But if you are looking at a stock that has a beta of 1, then that means that's generally going to track the S&P. It's going to move with the S&P. If the S&P goes up, it's going to move up. If the S&P goes down, it's going to move down. It's going to kind of track it like 1 to 1. If you have a stock with a -1, then it's going to track almost exactly the inverse of the S&P, right? So a stock with a beta of -1, if the market goes up, the stock would go down. If the market goes down, the stock would go up. Okay. If that makes sense, hopefully it does. If not, just rewind it 15 seconds and listen to it again. Okay. But if you need a bullish position, you're going to be focusing on stocks or ETFs that have a beta of 1 or more, right? And this is really important because what you often do, and you don't have to do this every time, but it's something that you can always definitely double check and look at. And, it's another thing that you can just like kind of glance at if you want to. But if you want to really get like the biggest bang for your buck in getting a new bullish position on, because maybe you're getting too bearish, then why not go for something that has a beta of 1 or more? Because then it's going to more quickly react to the market going higher. And so I'll give you an example of this so you can kind of like drive home the point here. SMH right now, which is a common ETF that we trade, actually, it's been very good for trading for us for like the last 3 months. We've been very profitable trading SMH. SMH has a beta of 1.16. So conceivably, if the market moves up, 1 point, and the SMH would move up 1 point plus, right? 1.16. So it would move up even more than the market. Now that's good. So if we need a bullish position, we might go after something like SMH because SMH has, a positive correlation with the market and is going to move a little bit, maybe even like ahead of the market if the market's rallying, right? So that's good. That kind of helps us correct our portfolio, much quicker. Now, let's take something on the opposite end. And I'll challenge you a little bit on this. So it might be a little bit confusing at first, but follow me on this because I really want you to get this concept. And I think kind of challenging you here on the podcast might help. TLT, which is a major bond ETF, something that, again, we trade all the time. TLT has a beta of -0.26, right? So a -1 would suggest that TLT moves the total inverse of the market. Well, it's not -1, it's -0.26, right? So if the market moves up, let's say 1 point, TLT might move down 1/4 of a point, right? So now if you want to get bullish exposure in your overall portfolio, you can't just buy TLT, right? Because buying TLT actually gives you exposure to the market going down, right? If the market goes down, TLT goes up. Does that make sense? Okay. So what you actually have to do is if you want exposure and you need bullish positions in your portfolio relative to whatever your beta weighting, so SPY in this case, you might actually have to sell 4 times as many bearish positions in TLT to get the same impact as one bullish position in SMH, right? Because what we want to do is we want to get TLT's beta to something around like -1 with the market. And then if we go bearish on TLT, we're taking an inverse position. And so that helps our overall portfolio become more bullish, right? So that's the kind of stuff that we're talking about. Hopefully that makes sense. But with TLT at a -0.26 and SMH at a 1.16 beta, TLT would require almost 4 times as many contracts to get the same impact as SMH. Again, if you're trying to get a bullish position on your portfolio. Now, here's another example of this just to kind of help out, okay? So let's say instead of SMH or TLT, you really want to get into a position in SLV, which is a silver ETF. And we'll talk about silver again later on with more examples, okay? But silver right now has a beta of 0.06. Almost a zero correlation with the market. So even if you were to go bullish on silver, it really has no impact on your overall portfolio because silver has almost no correlation with the market. If the market goes higher, maybe silver does or doesn't, right? Like no positive correlation with the market at all. So adding silver to your portfolio while you're adding another bullish position really doesn't help balance out what you have. And so it's not really a good trade that you want to kind of complement to your portfolio, if that makes sense, right? So it's having this understanding. And again, I'm not saying that this is something that you have to check like every single time, but like for me, like I look at these correlations like once a month, right? And I generally have an idea of like what's positive and what's negatively correlated. It's probably pretty obvious to say that bonds are usually negatively correlated with the market, right? It's probably, obvious that like a micro semiconductor ETF might be positively correlated with the market, right? So you get a feeling for these over time, and we'll give you some links to some resources where you can check these out pretty easily in the show notes. Just head on over to optionalpha.com/show104 and you can get those. But the idea here is that you just want to like be cognizant of what you're actually adding. It's not just enough to just add a bullish position to the portfolio. You want to add positions that are highly correlated with the market if you want to be bullish. Now, if we want to be bearish, so let's take the opposite side of this like conversation here. If we want to add bearish positions to our portfolio, well, then we need to buy things like TLT. We need to go long TLT, right? Because TLT has a negative correlation to the portfolio. So even though we're going long something, we're adding a bullish position in TLT. Because of its correlation to the market, right? We're actually adding some exposure in case the market goes down, right? And TLT goes up because that's what would happen. So if the market goes down, which is what we need in our portfolio, right? We need something that's going to profit in case the market goes down. TLT might go up or should go up based on its correlation or its beta. And so this is the type of conversation and thinking that you should at least do, like I said, like if you do it like once a week, once a month, like that's something that, is good just to kind of remind yourself of it. It's again, always a moving target. So it's never perfectly this. It's never, we got to get this beta all the time. So don't take it analysis paralysis to the nth degree, but it's just like having these thoughts in your head and these conversations with yourself about how you're adding positions and what it really does to the impact of your portfolio. And I always say like, you have to slow down in this business sometimes to speed up. And I think sometimes people rush through the process versus maybe just taking an extra day to really, look at a position, look at your portfolio, and then make a smart decision, right? In this case, going with SMH versus 4 times as many TLT, right? Like that could be an easy decision for you. And especially somebody who's trading in a smaller account, this is even more impactful because if you're checking out these betas and hopefully adding positions to keep you balanced, it could mean adding 1 position versus 4. And for a small trader in a small account, adding 1 position is a lot easier than trying to get into 4 different contracts, right? And over allocating. And so that's a really important factor. So one quote I wanted to give you guys, and this is from one of the reports that I read, and I just like always read all these, research reports and all these insights and 10Qs and 10Ks. Like it's a hobby of mine, whatever it is. But one of the hedge fund founders at Bridgewater, which is Ray Dalio, which I often quote all the time, he recently was quoted saying that with $160 billion under management, if you have 15 uncorrelated return streams, you can reduce your risk by as much as 80%. And so the whole idea here, and just to kind of like put this all back together, I was going to say pair this back together, but the whole idea of putting this all back together is that we want to try as much as possible in our portfolio to have as many weak or loose correlations to the market as humanly possible, right? And this changes over time, right? Because markets evolve and things change. They don't change like from day to day, but month to month and year to year, correlations between, let's say, gold and the market or commodities like oil and the market, they change over time, right? But what you want to do is you want to just generally have as much as possible a portfolio of weak or loose correlations. So again, I'll link up to one of the resources in here, which is portfoliovisualizer.com and all their asset class correlations. It's a really cool tool. You can just generally see like where the correlations are in the market. And we'll link that up in the show notes page at optionalpha.com/104. But 2 weak correlations that you might be interested in trading. This is where I come into the conversation about pairs trading. 2 weak correlations right now are FXE and SLV, which we mentioned earlier. So right now, we want to generally have these 2 trades in our portfolio. And we do. We have trades in FXE and SLV. This is where you can actually trade both of these securities at the same time. It can be a pairs trade if you want to do it like that. And they both have weak correlations to the market. So you don't have to be like cognizant of really trading them in any one direction. Like you could trade them both bullish. You could trade them both bearish. You could do one bearish, one bullish. But FXE has a correlation to the market or a beta of the market to the market of 0.16. SLV, like I said, is 0.06, right? So very, very weak correlations compared to something like SMH. This is really good. You can add these to your portfolio pretty easy and really not have any major skew happen in your portfolio. And that's what we want. We want lots of these different things, right? We want some FXE, some silver, some whatever, right? Now, when you add something like an SMH, which we talked about earlier, that has a positive correlation of 1.16 to the market, well, then you've got to add other things that might compensate for that, right? You've got to go short something else that has a positive correlation of 1.16 so that it neutralizes that impact of SMH, right? So let me just I'm going to just try to bring up one of the products here. So you might hear me clicking in the background because I want to kind of talk about this in as much live time as I can in recording this. Okay, so this is good, right? So I just typed in XOP, which is an oil and gas ETF. It has a beta right now of 1.51. Okay, so when the market moves higher, XOP should move just as high and then even 50% more potentially, right? So if the market moves a point higher, XOP should move 1.5 points higher, right? And so if you add, let's say, a long position in SMH, which now you're adding 1.16 additional betas to your portfolio, you could also take a short position in XOP and neutralize that impact by a large margin. Now, it's not going to be one-to-one, and I think this is where people sometimes get confused. Kirk, you added 1.16 betas, and now you're shorting 1.51 betas, right? So it's not going to be one-to-one, but it's that concept that if you go long in SMH, maybe take a short position in XOP, right? Because the markets are pretty neutral, pretty random anyway, and have a neutral impact overall on your portfolio. Does that make sense? To do that type of thought process, right? And that's hopefully what I want to get through here in today's podcast and kind of point you in that right direction. Now, here's the thing, right? And just kind of wrap this up real quick before we get into the Q&A and to the trades today. In today's world, there are very, very few, probably almost no ETFs that I found so far right now. And there might during some periods of the year, this month, that month, or, over time, there might be, but I haven't found any right now that have a perfect positive correlation or a perfect negative correlation or a perfect no correlation, right? So there's almost nothing out there that is 0, 1, or -1 exactly, which means that all of this is going to be a little bit of a little bit of art format, right? Versus exact mathematics and science for your portfolio, right? There's got to be a little bit of art to this because something like SLV is not perfectly zero. It absolutely doesn't have a total zero correlation in the market, but it's pretty dang close, right? And something like SMH has almost a perfect correlation with the market, but it's actually a little bit more, it's 1.16 versus 1, which would be a perfect correlation. So again, don't get so bent up on getting all of these things exactly right. I just wanted to add today in today's weekly show, just this concept of thinking about this and trying to be more efficient with your trades. Because I think if you kind of think about what we talked about earlier in adding one position to SMH versus 4 times as many in TLT, I think that really drives home the point of being really efficient with how you're using your capital and how you're correlating and beta weighting your portfolio. Again, it all gets back down to beta weighting and figuring out what you need in your portfolio. What does your portfolio need? And then starting to find the most efficient piece to plug in, right? That's really what we want to do. We don't just want to fix the problem, right? We don't want to rebalance our portfolio. We want the most efficient manner to rebalance our portfolio. So hopefully that conversation kind of helps today. And again, if you have any questions or need any help or support or feedback on this or anything and want to see the resources that we have linked up, head on over to optionalpha.com/show104. Again, that's just the number 104.
And now our favorite part of the show, Trader Q&A, where we ask a question from one of our current members about options trading. Got a question you'd like to ask Kirk to answer live on the air? Just head on over to optionalpha.com/ask and hit the record button to leave a message. That's optionalpha.com/ask. And now, here's today's question.
Hi, my name is Rene. I'm from Guatemala. I've been trading for 1 year in options. My question is, Kirk, can you please make a demonstration real or live with a suggestion of the watch list? Thank you.
Hey, Renee, thanks so much, man, for submitting the question today. And so what I want to do is, and I'll do this now, over the podcast, obviously, and you guys will hear me clicking around, but you can see a demo of this and kind of get used to it by heading over to our website and checking this out. But what I'll do using the watch list is literally what I do every day. There's no real change up to this. There's no real, differentiation that we do and how we kind of go and find trades. What I usually do in the watch list, and I say this on the demo video when anybody purchases access to it, is I search and rank by highest implied volatility and ETFs first. So we've talked about a number of times that I generally prefer trading ETFs, especially during low volatility, which is what we're in right now. We've traded things like Apple and Amazon recently and a lot of other, stocks, but generally we prefer to have these baskets of ETFs, right? And so I rank everything by high implied volatility, and then I filter out only ETFs, which is very easy to do. It's 2 clicks inside of our watch list. Now, right now, that gives me a list, top to bottom, the highest implied volatility setups to the lowest. And so I can go through this list of ETFs and see which ones have the best implied volatility. What is the low-hanging fruit, per se? Now, the first one on our list at the exact time right now is XLF. Now, we already have a position in XLF. In fact, we've just got into one just the other day. So that checks the box. Okay, so now I move on to the next ones. FXE, which we talked about earlier, already got a position in it, right? So I don't need to add to it right now. I don't want to do a ladder position right now. So I keep moving on. Now the next one is IYR. Now we don't have a position in IYR right now. And the one after that is FXY. So the next 2 ones that we find on our list that kind of popped up are IYR and FXY, which is interesting because now we can, start to look at those 2 a little bit further, right? And that's literally how I do it. It's no, I don't know, I don't want to make this and drag this out to be more than what it is. That's what I do. I find those and I say, okay, now let me look at IYR. Is the pricing okay? Can I actually sell some stuff for a premium? How far out are we? And I take all this information now of just figuring out that IYR is, something that we could trade. And now I plug it into, the back testing and the trade optimizer to figure out what strategy I want to use based on, implied volatility rank, how far we are till expiration, etc. To use kind of some of the stuff that we talked about today in the podcast as far as beta weighting and this pairs trading concept with betas. If I look at IYR right now, IYR has a beta of 0.67. So it is a positive correlation with the market, but it's not exactly 1-to-1. Now, FXY has a negative 0.25 correlation, right? So generally, if the market goes higher, FXY will go down. If the market goes down, FXY will go higher. In fact, today, as we're recording this podcast, the market's opened up lower and FXY is actually higher. So that positive or that negative correlation is holding true right now, that we actually see the yen starting to rally when the S&P is actually opening up down, right? And so if I wanted to do some sort of pairs trade concept with this, I could do one of 2 things, right? I could first trade both of these things neutral, but maybe skew the positions just a little bit based on these betas, right? So I could trade IYR, generally neutral, Iron Condor, Iron Butterfly, Strangle Straddle, etc., but maybe skew it just a little bit based on these betas. Skew it up or skew it down, depending on which direction I want to get that position on first. And then I could do the same thing for FXY. I could trade it neutral still because they're going to be kind of pseudo offsetting a little bit, right? I'll still have some positive correlation added to the portfolio if I trade both things 100% neutral, because I'll be trading IYR, which is a 0.6, and then I'll be trading FXY, which is a negative, right? Which is a negative 0.25, right? So I'll still have some little bit of positive correlation, but it won't be totally bullish as far as an ad. So at least I know that going into it, that I'll, have this kind of offsetting position. I'll trade one for the other, but it'll be generally neutral. It won't be this huge new bullish position. Or I could take the opposite of each other, right? I could go bullish on IYR, maybe, 1 or 2 contracts. But then if I go bearish on FXY, I have to do maybe 3 or 4 or 5 contracts, right? I have to do more to kind of compensate for the fact that FXY is a smaller, closer to 0 type beta security. So I have to do more contracts if I want to make it totally even and equal, right? And again, it doesn't have to always be exactly matching up, but it's just this concept of thinking about how these 2 positions might be relative to each other and how they might then fit into your overall portfolio, right? And especially if your portfolio is neutral like ours is right now. Ours is totally neutral, so we're more often looking for neutral positions. If you were totally skewed in one direction, you needed bullish positions, maybe IYR is a better position. Go bullish on IYR. It's got positive correlation with the market anyway. Take a bullish position on it. That helps your portfolio, right? Does that make sense? Hopefully it does. I know I'm asking you in the podcast right now, you're actually listening, talking to me, but that's just how I end up doing this. Okay. So hopefully that makes sense, Renee. And again, thanks so much for submitting the question to us. Again, if you want to get your question answered here on the podcast, or as we've been doing pretty much every day now on live on Facebook and Periscope, please head on over to optionalpha.com/ask, click the big red button in the middle of the screen, and leave me a private voicemail. Again, there's no software to download or install, and it's very, very easy to do. It takes you 2 seconds. Now, before we get into the closing bell segment, again, if you want to learn more about how we use our new software toolbox, commonly referred to as the toolbox, and all the different versions of software, including our watch list, our earnings calendar, our trade optimizer, and our backtesting tool, you can head on over to optionalpha.com/toolbox. There's a very nice demo there. You can see some screenshots of how it works. You can play around with actual demos of it and get an idea of how we kind of use these tools. Again, we built these tools, for me to kind of help, simplify my process, and then obviously are releasing them to you guys. So again, head on over to optionalpha.com/toolbox.
Now, the closing bell. Find out which stocks we're looking at right now, trades we're making, and hear our game plan moving forward.
All right, so in today's closing bell segment, I want to talk about the new trade that we got into today in EWZ. And this is that Brazil ETF. And I mentioned this before on the nightly video, and we'll mention this to traders, and that is that EWZ is the poster child for a stock that has completely turned around and really kind of like embodies this like market randomness like thought process or theory that's out there. Because what we recently had, not recently, but it's back in May of this year, and I actually think I talked about it on one of the other podcast shows because we actually used EWZ and that trade back in May as an example for a show, is we talked about trading EWZ when implied volatility was super high. Back in May, it like basically crashed overnight, which is uncommon for an ETF, but the whole Brazil market was crashing with this whole like political scandal thing that happened, and EWZ was down like 15-20% the next day. Now, we traded it that day, which most people would not want to step in front of that. We did. We ended up doing a couple very profitable trades around that. And since then, I've been pretty quiet in EWZ because implied volatility has kind of fallen off the map. But EWZ has regained that entire crash that it had back in May and then some, and has really started to reach kind of like new heights. Now, the problem is that when you look at a chart of EWZ right now, what you'll see is that the stock has gone parabolic. And so for us, it's now starting to reach, and it really hasn't even reached these levels until just recently, where it's starting to reach these technical overbought levels that we have, that we still use from our signals research that we published, right? Our big report on technical analysis. Now, this is really interesting for me because what I often see people do with technicals is they see a stock that's rallying like EWZ, which is basically rallied for almost 3 months straight. And they think to themselves like, okay, it's gone parabolic. It's got to turn around. But we have yet to get those technical signals that it was actually overbought and actually due for maybe some sort of pullback or at least a stopping in the momentum until just recently. And so that's why I think it's so important to, again, to use the right signals and then just to trust them and not like stray from them. So look, I have no idea where EWZ is obviously going to go, right? We're making a trade, with the assumption, based on the information we have right now, but right now, we see that EWZ has made a huge move off of the lows, regained everything that they lost in that, kind of like crash overnight, right? And then some. And so I think people are going to start taking profits here, and the technicals are showing that this could be a good area to start taking a bearish position in EWZ, right? Now, again, our overall portfolio is totally neutral right now. We can afford to take an EWZ bearish position, and then we just want to add something maybe later on, or just have the wherewithal that we're adding a bearish position. So maybe we want a bullish position later on, right? So again, kind of like try to tie this back to the whole conversation today. Now, in the case of EWZ, even though we want to take a bearish position, we're going to sell some premium here. And we're going to do so by selling a call credit spread that's out of the money. Now, at the time that we're trading this stock right now, EWZ is trading up around 42.5. And so what we're going to do is we're going to sell a 44 call for October and then buy the 46 call for October. So a $2 wide spread. It's got about a 70% chance of success. And we're taking in a premium of $56 per spread. So we're going to do 5 of these. We're going to be a little bit aggressive in it. It's still a small position because it's a small $2 wide spread, but we're going to do a bunch of contracts here and see if we can't get EWZ to move down at any point between now and October expiration. Basically, we're just going to force the market to continue making this parabolic move. And that's a trade like I would make all the time. I would make this trade all day, all night, every year, right? If I could, because it's forcing the market to do something that it's continuously like impossible to do. And that's continue to make parabolic moves. Markets do not make parabolic moves in one direction and never stop, never reverse, never pull back. It doesn't happen up, it doesn't happen down, right? It just doesn't happen that often, right? And so we're going to force the market to continue making this parabolic move and beat us by continuing to rally from 42.5 up to 44.5 by October expiration. But if it doesn't, if we have any sort of down move in the market between now and then we have an opportunity to take this thing off for a profit. And that's why I like this trade so much. So again, even though I like it so much, even though I would do this type of setup all the time, I'm still going to be pretty small with my allocation. We're doing a bunch of contracts, but it's a $2 wide spread. Try and take advantage of EWZ, maybe pulling back off of these highs.
Thanks for listening to the Option Alpha podcast. If you liked what you heard, please drop by iTunes and leave a rating or comment. Plus, you can get everything: free email updates for future shows, transcripts, video tutorials, case studies, and more. Just visit our website at optionalpha.com.
All right, so I truly hope you guys enjoyed today's show and got at least one thing out of it, as always, that you can apply right now to make you a smarter, more profitable trader and investor. If you want additional resources, some of the links that we mentioned in the show, and some related video training on beta weighting from today's show, please head on over to optionalpha.com/show104. Again, that's just the number 104. And until next time, happy trading.